Hi, Gavin Greaves here, one of the directors at Apex Advice Group. I thought we'd get out a video regarding mortgages and mortgage holidays. Now that we're pretty much on a weekend lockdown, everybody's sort of settling down and finding out where they're at in terms of their employment and sort of government support and there's different initiatives coming out. There's a lot of questions around those people with mortgages and what decisions they need to be making. There's three components, I guess. The first one is if you're in a good position from an employment perspective, you've got good income coming in. We're sitting at home now and all your outgoings should have reduced. So you must have got some additional savings available. It's a great time in this low interest rate environment to be reducing your debt. So if you've got that capacity, it's worth speaking to your mortgage advisor and working out if you can make additional contributions to reduce your debt and increase your buffer in case things do change. If you're someone that's sort of come under a bit of stress from an employment perspective or a business perspective and your income's decreased, either a small amount or a lot, and you're having some pressure put on your outgoings, there are two distinct options that are potentially available to you. The first one is going from a principal and interest loan where you're paying off the principal and the interest associated with it to just an interest-only loan. You need to see if you can qualify for that. If you can, obviously, the amount that's going out is just restricted to the interest, and that means you've got more available in your finances to meet your weekly requirements. Now, just be aware that that's not reducing your debt; it's just really a holding pattern to get you through this period. So you need to be mindful of that. Now, the third one is for someone that's must be in more of a financially difficult position, real constraints on their cash flow. This is an option we can go on what they call a mortgage holiday. Sounds good, and it is in the sense that it's going to reduce that mortgage expense, which for a lot of people is a big expense, both principal and interest. But what it is doing is it's just pushing the can down the road, essentially, and making the can a little bit bigger, because you still have all the principal to pay off, but all those interest payments that you would have paid off in that 6-month period, they're all bundled up, or what they call capitalized, and added to the loan. So when you get to the other side, the loan amount is going to be a little bit bigger. So look, they are all valid options and gives people, depending on where you are in the spectrum, a lot of choices. But to work out which one's right for you, it must be best that you speak to one of our mortgage advisors. They're there ready to help you. I know they've been flat out. They've had a lot of calls and been able to help a lot of everyday Kiwis make some good decisions. So give them a call. So that's it for today. Thank you very much.